Good morning. This is the Saxo Bank Morning Call for November 15th. It's a Thursday, and it's the day after the wait for this Brexit deal and whether it would pass Theresa May's cabinet. It did. Apparently a marathon session resulting in a couple of cabinet individuals resigning. It is a large cabinet, 28, so 2 or 3 resignations is not a big deal. The key members apparently still signing on, and the question is there still a path to a Brexit from here? It all looks positive on the headlines. Sterling completely frozen in a range because there are still so many uncertainties. We have the potential for this European research group, these Tory hardliners, revolting and calling for a confidence vote. They need a certain number of votes to be able to do that. And then if she does pass that, they still have to look at whether there are the votes, if there are Tory rebels, if there are votes from Labour and others to pass this deal. Just before we came in here, we had this date set for the Brexit Summit, November 25th. So that's already up in 10 days' time. And I think some things are going to need to change in this deal. We don't have all the specifics just yet. We'll be updating you day to day. First of all, we have to get over this risk of a confidence vote. But I still think it's a rough path here towards a Brexit. You have the hardliners on the Tory side having to decide whether they want to scotch the whole deal and risk chaos, elections, and a Corbyn government, and you have a Labour that's likely rubbing its hands together and hoping for that chaos because they do want to assume power and potentially call a second referendum. Just briefly, let's do a chart here on Euro Sterling. We can see where we are. We've been towards the lows of that range since mid-2017, the sub-87 lows, and we'll be looking at that on the downside. If it does appear we're moving towards this deal, I think the upside sort of knee-jerk potential is quite large towards 90 if we're talking about a chaos scenario. And it could get higher still, obviously, if we're looking at a so-called no-deal Brexit. Let's go to equities. We had a pretty rocky session in the U.S. yesterday, and then overnight, one of the big Chinese mega caps reporting, Peter, Tencent.
Yeah, we are moving into the late part of the earnings season, and Tencent has been one of those earnings releases that have been very much anticipated because we know of the Chinese weakness, and Tencent in particular has been curbed by gaming regulation that will come due here January 1st with only a maximum 2 hours of gaming per any children under 18 years old. So that obviously will have some effect on revenue. But Tencent actually delivered against expectation a little bit better actually, and the shares are up 4% in Hong Kong. I think potentially this could be a change. As you can see here, this chart looks very much like the Chinese equity market. We sort of established the bottom now over the past 2 months. I think there's a lot of money sitting on the sidelines and wants to be entering the Chinese market. And I've been saying before, I think we have reached the bottom. I think the 30% decline in Chinese equities is discounting so much negativity that even the slightest softness on the G20 meeting in later this month could actually see Chinese equities going higher from here.
That G20 meeting is very much in focus, something we've been talking about every day. We'll continue to talk about it. It does feel like the market is starting to expect something positive from it. I'm extremely skeptical on the medium to longer term, while admitting that some sort of agreement could be struck in the near term that could encourage what we're seeing in the market. If we look at the dollar here, euro dollar, we've seen it transitioning back above 113. To me, it's not quite breaking higher. We do have a descending channel that's still intact there. I'm looking at 115 as the real sign that something more significant is shifting in terms of dollar weakness. We did see a CPI small miss yesterday. We've talked with Ola about this massive slide in oil prices, likely feeding lower CPI data in coming months. You're seeing a Powell in a speech last night in an interview, a little bit more two-sided. He sees some risks going forward. And it could encourage the idea that December is the last rate hike for the cycle in some people's minds, and that would be a very interesting turn, of course, in Fed policy. I would argue that the QT is just as important, and I would also argue if we are turning lower in terms of our Fed expectations, it's for very bad reasons that the economy is looking weaker, which could provide its own source of dollar support eventually.
It seemed like the market was probably right? Because the market has constantly been at 1.5, 2 rate hikes, and the dot plots has plotted three rate hikes, and now he sort of is backtracking a little bit.
We'll find out. I think the Fed's intention all along was to avoid providing too much forward guidance. Agreed. And Powell has been very much against being sort of bound to any forecast, just saying, look, we'll take the situation as it comes. But Ola, let's get to you on oil. I mean, we've seen a crazy few days in energy markets in the U.S. What's going on here?
Well, there's obviously still a lot of speculation about why we saw that big sell-off the other day, and there are emerging talks that there's been a lot of delta hedging from swap dealers in some of the major banks, because there's a lot of hedging activity going on in the crude oil market, both from shale oil producers in the US who needs to hedge their forward production, but also the Mexican hedging program, which is the biggest in the world. These swap dealers, they are left with options that they need to look after, and then once we broke some critical levels, they really that really triggered quite a bit of selling. But if we look at the chart here, we can see we did find a little bit of stability yesterday. We have bounced off the low. This is the weekly chart, just to highlight the
WTI.
WTI, the strength of the sell-off. When we see such a big sell-off, we expect some verbal intervention to emerge, and we did see that yesterday. Now there are talk about OPEC potentially together with Russia looking for a cut between 1 and 1.4 million barrels a day. That's happening at a time where the refinery demand is about to pick up once again. So I think once we have this speculative froth out the way and we get the panic selling out the way, I think the market is probably going to find its feet down in this area. We got the inventory report out late today. The expectations are shown there on the right. So you can see API came out yesterday with quite another strong increase in crude oil stocks, close to 9 million barrels. If that is repeated once again today, that will highlight the continued rise in US stockpiles, and that obviously will create some headwinds here in the short term. But also I think we need to keep an eye on especially something like distillates. Distillate stocks are starting to run quite low, and that could potentially become crude oil savior.
And then on the natural gas market, it's virtually gone vertical here, and there's talk of perhaps some funds getting into trouble on that account. It's not just the weather, although the weather is a very extreme story here.
Yeah, absolutely. It's difficult to argue that a change in the weather at this time of year it really should result in such a big spike as the one we've seen. It is the biggest jump in 8 years. We have seen an early winter freeze in the US, and that is creating some nervousness about the level of stocks, which you can see on the top right. This is stockpiles heading ahead of this withdrawal season, which begins in a few weeks' time. We have the weekly storage change today. The table is down in the left-hand corner. That's coming out. I think, John, you got the table towards the end, showing the timing of those. But we're looking for a small injection of 33 billion cubic feet. That basically means that we're not going to catch up, and with this cold over the next couple of weeks, that's going to be even less so. Just want to highlight the bottom right, because that's the famous Widowmaker. That is basically the spread between the last winter contract and the first spring contract, and you can see the
March to April of 19 there.
Exactly, March to April, and you can see that how that spread has jumped very dramatically in just a couple of days, and that just highlights this seasonality that the injections doesn't start until April, and that means we are in March we're still depending on whatever is left in stocks from this year. So that's why this spread creates some huge moves.
And also, I think oil prices, the low oil prices, perhaps being felt a little bit, a combination of oil prices and all these hopes around China and a strong Australian dollar. We saw pretty good jobs figures out overnight from Australia. I never have understood why the market reacts as much as it does to a very lagging indicator like employment. But let's have a look here at AUDCAD. I think this sort of Aussie squeeze we've seen set in motion, it's reaching, I would almost call it ridiculous proportions at this point. You could argue Aussie dollar, if the dollar's turning a bit here, could have plenty more room to run. But in some of these crosses like AUDCAD, to me it's looking quite stretched here in terms of the further potential higher and hopes around a China deal. But let's have a look at it as we transition into December. But just one thing to note out there is crosses like AUDCAD, Aussie NOK, and others. What else do we have here? We have gold. Interestingly, we had a bit of argument about what's driving this gold. We saw a pretty decent bounce in gold yesterday. I think it makes somewhat sense in light of we've seen the market pulling a bit of expectations out of the forward Fed expectations, which is always going to help. Slightly weaker dollar. But this is a pretty big move, and I was wondering if Bitcoin might be playing a part here.
Yeah, I posted just a tweet this morning on Twitter, and just showing how the collapse in Bitcoin yesterday and the rise in gold more or less occurred within the same time frame. So that obviously can lead to some speculation, but one thing for sure, that Bitcoin is reaching the lowest level in a year, so that it's not being really viewed anymore as an alternative investment to something like gold. But if you look at the chart here, just highlighting that we held on to this 1200 level, the uptrend since the low back in August, I think probably more important is the one on the right, silver. We broke below 1400, and instead of seeing some accelerated selling, we actually did see some buyers return to the market. It probably also helps that silver right now is trading at its cheapest level to gold since 1993. The gold-silver ratio is trading above 85, and that's supporting. I think also there was some news from China overnight that infrastructure spending was on the rise, and that has given copper a boost, thereby also a indirect link there to silver.
Peter, we've seen a pretty decent unwind in some of the Fed expectations out in 2019. This used to be something that the equity market celebrated. Do you think the equity market's in the mode of celebrating a potentially less hawkish Fed, or just the sort of reflecting that a less hawkish Fed is merely because of actually quite bad news cyclically? Or do you have any feelings on the market's feel for what the Fed is saying and doing?
I think the economic backdrop in 2019 is going to be more important on one or two rate hikes back and forth in 19 and the language. I think the backdrop to 2019 looks quite soft, as he said yesterday, Powell. I think whatever deal is struck between the US and China, or if not, is what's going to drive the equity markets, at least in the US and China going forward. So no, I don't place that. I don't think too much of Fed expectation right now.
Okay, let's go to our calendar, which is awfully busy for the day. We have so much out of the U.S. session. Some UK retail sales up this morning, and various other bits and pieces. And then we have a pretty busy U.S. Calendar with the retail sales, perhaps the highlight. As we mentioned with Ola, the weekly nat gas inventories, that's the most volatile market at this point in time, but also the latest DOE weekly inventories there. And we have a Mexican central bank hike expected quite late in the North American session. All as we wait for additional signs out of what we should expect at this G20 meeting and the meeting between Xi and Trump. There was actually a pretty discouraging note from Vice President Pence, talking about if China wants to avoid a Cold War, that is up to China. On that note, we'll leave you for today and be back tomorrow for our final morning call for the week.